Okay, Shiv, how was your day so far?
Oh, great day. What about you?
Super, man. Chugging along,
Coming along. Good times at hBits.
It's been a busy day and I see a lot of energy and movement in the office. Let's get started. Tell me a little bit about the tech in prop tech and specifically at hBits and what are plans on that part?
Yeah, I mean, tech is a very important part of our platform, and we endeavor to have the best customer service
Yeah.
through tech. And let me talk about it. There are two different parts of the tech, right? Because there are two different parts of our business. One is the investor side,
Yes.
and the other is the real estate side. So we'll talk about I'll talk about the investor side, and maybe you can talk about the
Done.
real estate side.
Done.
So in terms of investors, I mean, even as of today, we have 30% of our customers who are NRIs, which means they've all invested digitally.
Wow.
Right. So that's just the.
They've not stepped a foot in our office. They've not stepped a foot in Bombay. They are sitting in their homes and offices.
Well, I guess they've not stepped anywhere to invest in our property.
Yeah.
Because it's so simple, few clicks of a button, and four parts of the investment process. First, you're understanding the investment option.
Yeah.
Right. So all of that is easily available on our platform. Your photos, your video walkthrough, your financial model,
Yeah.
to the level of your title report, your legal license agreement, they're all available on the platform.
So it's all digital.
Yeah. And any decision you need to make is all available online. In fact, what you would use at Everstone,
Yeah.
all the documents, details you would use at a company like Everstone when you were there, or at Logos, Indospace, all that is available to the investor on our platform.
Yeah.
So they know everything about it. It's like as if they stepped into the property, they've got all the analysis. That's available at a click of a button.
So it's like a virtual tour / a virtual data room of information.
Yes, virtual tour is something we're planning.
Yeah.
It'll come very soon.
Okay.
But yes, it's as if you're part of that property.
Got it.
So that's the first step. Anything you made, you can invest.
Done.
Next step, you've decided to invest. Right? So you need to sign, you need to make payments, you need to do your KYC. All of that, very easy. Few uploads, few signs, and you can do that online. Again, direct transfer from your bank account.
Yeah.
Very easy, very simple. You've invested in a property. You're sitting in New York, you're sitting in Singapore, you're sitting in Bangalore, and you invested in a property in Bombay. So very simple. Then you want to track your property. Again, all of that, the same way you track your stocks,
Yeah.
say a Zerodha,
Yeah.
you can track on our platform.
That's the digital dashboard.
That's the digital dashboard, exactly.
Got it.
So, your rental disbursements, how it's fared that month, when exactly it's come, any updates of the property in the neighborhood if the rent has changed,
Yeah.
in any other building that will have an impact on your property value, we put those updates on the platform. We have an annual valuation of the property so you can
Yeah.
see all your previous documents are there.
Yeah.
The kind of information you would get from a stock portfolio, you have here on your dashboard.
Got it.
And finally, it's the exit. You can exit your share on the platform with a click of a button. We have 50,000 other investors in the platform and growing. So
Yeah.
they can come at any point in time and buy that from you. So that's where the prop tech is there as of today.
So that's the secondary market we were talking about earlier.
That's the secondary market, exactly.
Okay.
And that's just as of today. And I think you touched a little upon what we're working on, the tech team is working on.
Yeah.
Virtual tour of the property. It's as if you're there. So that's one. The kind of analytics we're building even before you analyze.
Yeah.
Right? Like for instance, a lot of information we have is on an IM, on a presentation that
Yes.
you download. But now what we do is you can click on a map, zoom in, you can see all the transactions. So it just becomes much more easier to understand. It's much more user friendly
Yeah.
if someone wants to invest. It's the same information, but it's how you present it and
Correct.
what you make of that information
Correct.
that allows a person to invest with much more ease and simplicity. Even on the dashboard, there are a lot of new features that we keep implementing.
Yes.
Customers ask us that just make the process much more smoother. So that's on the investor side.
Yeah.
Maybe you can talk
Sure,
on the real estate
sure.
side. Yeah.
So I think that I think the world is moving towards tech and has been and will so more even more. What we do have is access to an excellent database out of CRE Matrix. They've done a good job of collecting and presenting a database that's queryable and searchable in terms of transactions, sales, leasing, and fair bit of analysis as such. What we like to do after that is basically analyze the data in terms of historical as well as projected growth based on that, in terms of capital values, leasing numbers, and not just gross leasing, but net leasing numbers, which is net rental. And luckily, we have access to information or granular information like what is the property tax, who's paying the CAM, uh, whether it's a fitted out property or not. And we arrive at a true net rental based on that. And that's very important in analysis in terms of running comparables, right? Because you don't want to overpay for an asset, right? Ever. And you want to make sure that it's rented at the right number also. It's not overleased, for example. Because if ever we are in a situation where the tenant chooses to leave after a lock-in expires, we should be able to rent at a similar or better number, right? Yeah.
So that's what you're doing as of today.
Yeah.
With the data that you get from CRE Matrix.
Yeah.
And then there's what we'll do tomorrow with that data.
Yeah.
Which we were discussing. It's that the plan where that tech comes in is the full role that the real estate team, the acquisitions team is coming in. We're also working with our tech team
Yeah.
to automate that process, to add algorithms to that process, so we can predict using that algorithm what is the right price to pay for that asset.
Correct.
And one is the CRE matrix data, which gives you a full picture into demand, what demand has happened in the past in that micro market, whether it's rental or sale.
Yeah.
And second is the supply. You can track, through government websites, what stage of approval a property is at. Is it under construction? Is the IOD received? Is the CC received? What square footage is approved? If you can track what the demand has been and what the supply is going to be, you can predict what the demand will be and what the supply will be, and you can put a right price for the asset.
And how it moves going
Exactly.
ahead. Yeah.
Exactly. So that enables us to scale up so much quicker. We can quickly analyze properties.
Yeah, I think that's where this market is headed, right? I mean, some of the recent developments in AI and machine learning we have seen, like so ChatGPT and GPT-4 and Bard with Google. I think some of that needs to filter into our business, and it will.
It will.
And we'd like to be at the forefront of that.
On the real estate side, we'll see the implementation of that probably, I'd say, 6 months to a year down the line for us.
Fair enough. You mentioned something about exits as the last piece for our investor base, whether secondary or as a whole. Can you tell us a little bit about, or how was the experience in terms of generating the first and probably the most profitable exit in the fractional real estate space?
Yeah, I think that was a huge success story for our investors and for ourselves. We exited an IRR of 17.5%.
Wow.
Which is an industry best.
Yeah. What was the projected number when you underwrote that?
The projected number was 15 odd percent.
Got it.
I forget the exact number, but in that range.
Got it. So we beat the projection.
We beat
it hollow.
So let me tell you about the story of that exit.
Yeah, please.
So it was the first asset that we listed on our platform.
Okay.
We had about 20-30 investors that had invested in that asset. And we held it for a year and a half. Investors were getting their rent on time. In fact, it was held through COVID. And while we're discussing that, I'd like to mention that during COVID, we had 100% collection in rent, 0% delay. It's because of the kind of tenants we have, the strength of our agreements. Yeah, so we had 100% collection in rent. So obviously rental is a big part of the IRR and the appreciation. So because of our agreement strength, the quality of tenant, 100% collection.
So excellent lease management,
excellent
property management.
Yes. Yeah. And then what happened a year and a half down the line, we were not even in the market. But at the same time, given our background in commercial real estate, we are very well connected with a lot of the brokers, partners in the real estate space. So in fact, we had an inbound offer come in because we're already always in touch. They know our portfolio. We discuss with them.
Yeah.
So one broker said, "There's an investor. Would you be interested in selling?" And this was just a year and a half into owning the property.
Yeah, which is not typically our time to sell, right?
No, we start getting the market generally 4 to 6 years down the line.
Yeah.
But at the same time, this is an example that we still keep a pulse in the market in case we get a good chance. So the offer came in.
I mean, you have to be flexible, right?
Be flexible. If there's a good deal, there's a good deal. The offer came in, a little bit of negotiation. The number we arrived at gave an IRR of 17.5%. We went to all our investors because obviously when we exit, it requires 75% of our investors' approval.
Correct. By value.
Yeah, by value. And in this case, 100% agreed. Great IRR.
Yeah.
And all the investors reinvested that in the next property.
Super, man.
So it was a great success story for us.
Yeah, it's a real feather in the cap, right?
In fact, I'll give you an example of another asset that we did.
Yeah.
We haven't exited yet, but we figured out the mark-to-market value is amazing. The property is in Andheri. It's rented out to ICICI Bank. We picked it up at a per square feet rate of 11,661 rupees per square feet.
Wow, very precise.
They're very precise. That's how precise we are. And we picked that up in 2021, beginning of 2021. Yeah, it was May 2021.
Okay.
And we found out a year later, I think in June 2022, another transaction has happened in the same building at approximately 16,000 rupees per square feet. So in just 1 year in the same building, there's an appreciation of, what is that in percentages?
Almost 30-35%.
Yeah, so we're not exited that, but
Yeah.
it's at a good value right now.
Yeah, we're sitting on a good notional return.
Yes, correct.
Or our investors are rather,
Absolutely.
right? Amazing. Speaking of the lease and the giving pulse on the market, and given, I guess, your lineage and family background in the commercial real estate space, maybe tell me a little bit about the lease management, property management, asset management bit of it.
Yeah, so I mean, you touched upon that, right? So my family has 30 plus years of experience in commercial real estate development. That gives us, great relations
Yeah.
with all the brokers, all the IPCs, your JLLs, Cushmans of the world, direct connect with the admin heads, HR heads of a lot of these MNCs.
Yeah.
So we have a pulse on the market, in terms of, who's moving where,
Correct.
what the tenant requirements
What
are.
deals are happening.
And that allows us to first pick up assets because we know whether the micro market is good, what kind of demand is there. We're confident, that when you have a large number of assets, at some point a tenant will leave. It's natural.
Yeah.
But we have confidence that we'll be able to release it soon. And also because of the work that you're doing, Mayank, in picking up assets at a good pricing and a good rental, that tenant leaves, we're very certain we'll be able to get a good exit.
Yeah.
And but because of that knowledge, we're also able to, most likely, at least in the portfolio that we have right now, no one looks like they're going to leave.
Yeah.
They're all there for a long time, they're stable there. But even if it does, we're very confident. But I think that's a very important point.
I couldn't agree more, man.
Because that the understanding and the knowledge of how to lease a property.
Yeah.
Very few people have far in between. I don't think a lot of people, might have that knowledge. And if you've never done it before, there's a huge learning curve.
Of course.
I think that's something that we as a platform, hBits specifically,
Yes,
has,
yes. I think that helps, give us confidence in terms of when we're underwriting.
Exactly.
And B, if it ever push comes to shove, I think we'll be able to deliver on protecting our investors from that risk,
Correct.
which has been theoretical so far, but we have the practical experience to actually deliver on that.
You said an interesting word there, risk.
Yeah.
Let's talk on risk. Any investment has risk.
Yeah.
Right? Including fractional ownership.
Of course.
So,
of course.
What are the risks in fractional ownership, and how do you, as our CIO, kind of take care of those risks?
I think any reward comes with risks, right? And this is typical. Finance 101, right? Risk adjusted return, risk reward ratio. I think you touched upon a little bit of that in terms of at the time of underwriting.
Mm-hmm.
I think if the underwriting is solid and the investment analysis is thorough, a lot of the risks or issues that can come 2, 3, 4, 5 years later are addressed on day one. So let me give you a few examples. Number one risk is vacancy, tenant leaving, right? What we do for that is ensure that there's a good residual tenure, a good residual lock-in period. Number two is tenant underperformance or misperformance. For that, we look at the lessee's financials, basically their intent and willingness and ability to pay rent on time and to honor the escalations and things of that sort. Third is maybe the micro market, in terms of new supply, or let's say what happened in Nariman Point 10 years back. That's a kiss of death, right?
Right.
So if one had the foresight, they would not invest in Nariman Point, 10, 15 years back. I think maybe that's a very easy example, but that is the kind of example I'm talking about. If there's so much supply coming, your rent will see some pressure. So thorough micro market analysis is one more example of how we can de-risk that. I'm sure I'm missing some points, but that's what I can think of right now.
No, and the ones that the risks that we don't have, right?
Yeah.
compared to other real estate investments. There's no construction risk, no development risk, no
Oh,
approval
of
risk.
course.
Building is already in place.
Yeah, yeah.
OC is there. We work with Shardul to get our legal due diligence. So I think it's very important to see the risks that are not there.
Yeah.
And yeah, you rightly mentioned vacancy risk is a risk, and the way we mitigate it, I think, underwriting it well, and
Yeah.
then having the strength to release. When
Correct. And I think if rents move a little bit here and there, the off-market deals or some of these proprietary deals that we're generating or sourcing,
Yeah.
we're underwriting at cap rates or entry yields which are very comfortable in terms of seeing downward pressure in the future if needed, right? We're kind of protected now.
Yeah.
Given where interest rates are, I think the repo rate is 6.6%. FDs from solid banks are 7.5% per year. This is probably the best time to invest in commercial real estate.
How does interest rates play a risk on exit though?
So right now, interest rates are pretty high, right? We're probably going to see maybe one, max two upticks, and then we'll see some stability on the interest rates, and they'll go down. All that'll do is basically reduce cap rates. Maybe, although cap rates are a multivariate, it's not necessarily directly and only correlated to interest rates. That's part of the puzzle. That's one variable in many.
I think the advantage that we have is we don't have we have to sell in 4 years or
yeah.
have to sell in 5 years.
Yeah.
We can hold if the real estate is in cycles.
Correct.
There will be cycles in real estate.
100%.
The benefit we have is that rent is still coming. You hold and you ride out the cycle. We have no debt. There's no pressure.
Yeah.
You sell after a year when the market favors you.
Yeah.
I think.
Correct. It's not a fund, right? There's no close-ended pressure from LPs to exit. There is no fund life concept. It's our investors and it's their will. If 75% by value are okay holding on, there's no issue at all. And these are patient investors, and
I think most of our investors take a long-term view.
yeah, and that's the case it should be, right? This is not.
That's when you get appreciation.
Correct. Okay.
Great.
Thank you.
Thanks,
man.
Amazing.